the management team from IIFL as well as the business heads. We have with us Rajesh Rajak, who is the CFO, Monu Ratra, who heads housing business, then Saurabh Kumar, who heads gold business, Anu, who is IR. Uh, yeah, so those are the participants we have from IIFL Finance. I would request now Rajesh sir to maybe give a brief a speech or brief presentation if you have for 5-10 minutes, followed by the questions from Sanjeev sir, who is our head of research, and then if there are any questions from the participants who have joined us, we'll take those questions. So over to you, Rajesh sir.
Thank you, Sanket. Warm welcome to all the participants. We are from IIFL Finance today, just giving you a brief snapshot about the company. We are a retail diversified NBFC, more than 50,000 crores of AUM. We are present all over India through a network of more than 3,300 branches. In terms of people, we serve our customers primarily 30,000 employees. Our customer segment is largely the segment which is untapped or underserved by the traditional banking sectors or the traditional sectors of the financing. And largely the trend that has been observed in India is there is a formalization of credit that is taking place. People still borrow, but a large percentage of the borrowing is from informal sources. And as they enter into formal, as they start dealing with formal lenders like banks and NBFCs, we are basically present in that intersection where they can move from informal methods to formal methods. So which are the products that we offer? So our offering is largely the small ticket retail granular. We are almost 95% retail NBFC. About 1/3 of our book each is gold loans and home loans, and the remaining 1/3 is basically divided between business loans and microfinance loans. Last year was quite healthy for us. We had a 15% top line growth in terms of AUM, but our bottom line expanded by almost 60%, close to 1,200 crores, and showing very good return ratios in terms of 2.7% for capital return on assets, as well as 20.6% on return on equity. As I mentioned, our 4 key products are those that I mentioned, and we are very bullish on all these 4 segments. And that is why our branch network expanded by close to 35-40% over the last year, because we want to take our reach to even more deeper geographies. Most of our branches and our customers are in the tier 2, 3, 4 onwards centers, and that's where we expect to meet our customers. Our companies are quite strong. We have the IIFL Finance capital adequacy at close to 24%, where the minimum is 15%. The home finance is in excess of 30%, and we have a microfinance company also, which is close to about 18% capital adequacy. So we are a unique mix of strength, stability, high profitability, high return ratios. And in terms of that is what is a complete package that we offer to our investors as well as to our customers. Yeah, so this is briefly about what we are all about, and I think let's move on to a more interactive session.
Yeah, thanks. This is Sanjeev here. Thank you for joining, all of you, on this call. So my first question actually start with the liability side, because I guess that's where all the issues are right now as interest rates move up. So want to understand your strategy on that. Like, how are you trying to kind of keep it less volatile? What about diversifying? Like, what is the strategy there? How are you trying to kind of think through the whole liability part?
Sure. So, Sanjeev, close to 35% of our book is basically off balance sheet, which is represented through securitization and assignment. So there it's a complete match. It's a one-to-one match between the assets are directly linked to the liabilities, and what we get is basically a spread on those assets. Depending on the product, the spread could be different. Likewise, on the other 65%, our loans are either variable rate loans like home loans and LAP, or if they are fixed, then they are extremely short tenure. For example, the average gold loan is typically lasts for about 9 months to a year. A typical microfinance loan, which is fixed in nature, but the typical life is about 18 months. And so, yes, as expected, the interest rate cycle will move up. The expectation in terms of our cost of funds could be something in the range of 100 basis points. If repo, finally settles at six quarter, but that will happen over a period of time because we also have a large percentage of our liability profile which is fixed in the nature of NCDs and so on. And the fixed, even the variable rate loans will reprice only over a period of time. So all in all, our ability to pass on the price to the customer and our asset durations being either variable or shorter than the liability durations will hold us in good stead for the coming quarters.
And in terms of, how are you looking at it in terms of, is there a proportion like how much NCD or how much bank or what are you looking at as what is your ideal mix of liabilities?
We try and focus on a complete diversification. So if you see today, we have about 35% which is to securitization and assignment. Out of the remaining 65%, we would have a combination of bank loans, which would be close to 40-50% of the remaining. We would have about 30% from the bond market, which includes public bonds as well, which is the public issue of NCDs. Last year, we had strong public issues of close to, in calendar 21, close to 2,500 crores. We also have a large pipeline of close to 10% of our funding is from refinance agencies like NABARD, NHP, SIDBI, Mudra, and so on. And foreign borrowings as well. About 15-16% of our borrowings comprise of borrowings from the overseas market and through ECBs. So basically, it's a whole package. We try and make sure that no single source of financing is very high or majority share of the total financing, because that could basically in times of stress could lead to blockage there. So that's going to be a focus, not let any one source go above say I have a majority share of the entire sourcing.
And you just mentioned that you have foreign loans as well. Is this in dollar or?
So yes, so these are in dollars but these are completely hedged.
Right.
So to that extent, what happens is typically the dollar-based financing, depending upon which time you took the loan, but they typically turn out to be a little costlier than the rupee financing. But in the interest of diversification and demonstrating that a large set of lenders is willing to deal with you is of great value.
Sure. Yeah. No, fair point. And so you still have a pretty decent capital adequacy in terms of, where are you on the credit rating cycle, and where do you think you're kind of can go?
So we are AA rated.
Yeah.
By Crystal, CARE, ICRA, all the 3 rating agencies, and we think we have a strong case for a rating upgrade. The last 2 years, FY21 and FY22, have seen tremendous stability, profitability, liquidity, and all that. But as with rating agencies, for good news, they typically want to see that or observe that over a longer time frame. So we are confident that the time frame for which they want to observe this better performance will soon be to their satisfaction, and we will get an outlook change first and then a rating upgrade. So
right. But in terms of your aspiration, like, do you want to be ever a AAA? Because there is a cost benefit to that, right? Because they would want you to maintain a certain capital adequacy and so on from in long term. So what is, again, do you have a thought on that, or what's your view?
Yes, absolutely. I mean, that ultimately is the ambition that one fine day we should become AAA. Yes, demonstration as to strength of capital adequacy, etc., will have to be made. Our capital adequacy at between 25 and 30% for the thing is as good as any other AAA company. So I don't think it's a trade-off. It's an aspirational value. You need to have basically for AAA. You need to have dominance in certain markets or ability to draw of funding even in down cycles. Ability, kind of pricing power. So there are many things that rating agencies look at. Good asset quality, and if you see, all these things are good to have even otherwise for an NBFC. Forget about the ratings. These are the things that you should be having to if you are to become a strong company. So yes, we are, I think, getting bigger and better every year, and ultimately that will be the aspiration one thing.
Sure. And from capital adequacy perspective, you think this is where you would like to be, or is it like 20% is what you like to be? Is there some number that you think that that's kind of a long-term goal to be at?
No, we actually don't chase any particular number. So I think these levels are also adequate enough. But what we do think is that our strategy is basically to keep the balance sheet as light as possible. So we originate assets with an intention that it can be downsold to somebody in terms of assignment or securitization. So what will happen over a period of time is while we'll have strong AUM growth, let's say 20% or so, we will have the loan growth or the balance sheet will not grow by that much. But at the same time, our profits are accruing at a healthy pace. So that itself will take it higher by about 2 to 3%, just the internal accruals every year at a group level.
Right. Fair point. So coming to the other side, which is of course the loan side now, and as you said, 1/3 is housing finance, 1/3 is gold loan. Let's start with gold loan side. And in fact, when we did our channel checks couple of months ago, and we actually heard your name quite a lot on the ground. So clearly, you guys have made a dent to in the space and that. So what is the strategy here, and how, like, what is really your right to win in that? What are you doing that you are able to challenge, let's say, the current biggies there?
Saurabh, you want to take it? So Saurabh is our his heads our gold loan business,
Sure.
and he's can I don't think I'll be able to answer it as good as him. I'll leave it to the expert to answer this.
Sure.
Hi, Sanjeev. Good to hear that people are talking positively about what we have done in the past few years. I think the clear strategy for us is that we have expanded our branch network. Our services, we continue to be nimble and agile. That means our response to different markets and opportunities is fast and very quick. And the way we have a 12,000 plus workforce, which is well trained, well oiled, and continues to be delivering on the required parameters. So large distribution network, strong technology, strong risk management practices, and strong template on branding, hyperlocal activities, creating awareness. So strong brand awareness in the market is what helps us to really win in this market. And at the end of the day, we have to be customer centric, and we have in last 5 years we have continuously focused on being what customer centric, being what customer wants. So last set of my customers are business borrowers. They have a different cash flows, they have a different requirement. We cater to them by different schemes that we offer. A certain segment of my customer is farmers, and they need a longer term loan, a 6 monthly loan, etc., etc. So we have loans and schemes which are customized to the customer needs and not one size fits all. So that's where we continue to focus on, so that one, the customer is not hassled and he continues to be with us for a long time. As you know, that gold loan is a very is a repeat business. 70% of my customers are repeat customers. So as long as we continue to be focused on the customer, focused on his needs, and give him the product offerings as per his requirement, we'll continue to be in business and continue to build a large scale. So
Right. But in terms of your strategy to get the market share, like, are you pricing it better than, let's say, a Mathut, or like why would someone come to you, let's say, vis-a-vis, let's say, a Mathut, or vis-a-vis even a bank for that matter, like so what's your strategy there? Or do you think, the interest rates actually don't matter, it's much more service which kind of matters?
So I think undercutting is not a long-term strategy. So it can work in the short term, but it does not work in the long term, right? So if you underprice yourself for a long term, it does not work. So the overall focus is that how do you deal with the customer? How do you acquire those customers? How do you continue to build that pipeline funnel of new customer acquisition, retention of the customers? And that's where the whole play lies.
Right. And so, in terms of spreads, currently, where are you on that? And do you think that you will kind of maintain those spreads in the gold loan business?
So yes, I would say there was a pressure on yields maybe in the last quarter to some extent. But as we look at this quarter, as we go forward, the yields are improving, and most of the NBFCs are back to normal rates. So the entire issue of teaser rates, etc., has gone out, and the whole focus is now getting the right set of yields. So we'll continue to see improvement in yields as we go over the next few quarters.
Right. And of course, like, gold loan being what it is, I guess you hardly have delinquencies, but you could have situation where you need to sell things. So are you, what is your experience there? Are you seeing that people actually not, I wouldn't call it, default, but is the stress level, where are we right now vis-a-vis, let's say, in the past, or what's your take there?
So in the last 5 years, when we started, as I said, we have been focused on the customer. So if a customer takes a loan, and suppose he takes a 1 lakh rupee loan, and he has an interest servicing of 1.5% per month. So if you collect from him in time or on a monthly basis, you'll be collecting 1,500. But if you collect after a quarter, the accumulated number would be 4,500, and after a year, it will be 18,000 rupees. So right from the beginning, our focus has been to ensure that we continue to collect on time, and we continue to service the customer, retain the customer in the fold, and it does not go out of our ecosystem. The moment a customer loses his gold, he is not likely to come back to us. B, he will spread bad word of mouth about our organization. So therefore, our focus has been to collect better, focus on the schemes that the customer needs and that he can service on time, and ensure that the auctions are minimized from time to time. Also, we have deployed a large collection team all across the branches to ensure that there is adequate focus on collection at big branches, at high NPL locations or probable locations. Also, we have improved over the period of time. We have really improved on how we look at collections. So we have a strong analytics and risk team which looks at triggers, etc., from time to time, which helps us in reaching out to the customer in time and ensuring that we don't lose the customer.
Sure. Also, in terms of, I guess, as you said, these loans are very short duration loans, and costs then matter a lot, right? In terms of ability to keep the cost to income as low as possible in this business, because if someone returns the money back in, let's say, 1 month's time, it's versus a long duration loan, it's very different. So how do you do that? Like, how are you thinking of keeping the costs in control? What's your strategy on that?
I think we lost you for some time.
Okay, no. So let me repeat. In terms of cost of doing business, the cost to income ratios, I guess, are very important in this business because these are very short duration loan, right? So how do you manage? Like, what is your strategy on keeping the cost low as low as possible?
So cost to income is primarily a play on how do we deal with our people. So large cost is infrastructure, which is your rentals, and then there is security cost, and then there is a people cost. The whole focus is on optimizing all these costs from time to time based on the quality of people that we hire, based on the kind of training that we give, and the kind of productivity that we do. On the other side, it is the AUM per branch which makes the big impact. Yes. So the whole focus is while we continue to manage costs by containing costs on each of these elements, we continue to focus on growing the AUM per branch, and therefore the overall cost to income will be will be more or less under control.
Sure. And currently, your AUM per branch, how would you compare with the, established players like, let's say, a Muthoot or someone? Like, how far are you on that?
So as per the published data, I think Muthoot is about, say, 12 crores, 11 to 12 crores. Manappuram is at about 5.7 crores, thereabout. And we are at about 7 crores. So the whole focus has been to grow the AUM per branch. And I think there is a lot of headroom available for us to really grow there. And we have to keep in mind that a lot of new branches have come up. So as we go along, the overall AUM per branch will continue to improve as the productivity goes up.
Right. So if I look at, your growth strategy, you would say that right now there's opportunity both to grow branches and grow AUM per branch. Is that right way of looking at it?
Very true.
Okay. And you think, maybe 10, 12 crores is maximum that, you then at that point you kind of become a bit more saturated, or?
I don't think 10, 12 crores is a benchmark. We have branches which are at 20 crores, 25 crores, 30 crores as well. So it all depends upon the geography, the location, and the opportunity in that catchment. So the whole idea is to mine the catchment, hyper-local catchment, and continue to build a strong customer base.
Right. Sure. And your view, if I look at the overall industry, what can be the growth, let's say, over the next 4-5 years in this industry? Because this is one question that we keep getting, that gold loan in the end is not actually cannot be a very fast growing industry, right? There's a limit to how much it can grow.
Very, very interesting question. See, the overall addressable market, Sanjeev, is more than 12 lakh crores, right? Out of that, only 35% is with organized players, 65% remains with an unorganized segment. If you look at the overall monetized gold in the country, is less than 10%. So if you ask me, the opportunity is much bigger, right? And the gold loan industry has been growing for the last 5-7 years at the rate of 13 to 14%. So the market is very big. The opportunity is very big. It all depends upon what kind of execution that we look at. And my sense is 10 to 15% should be a normal for the gold loan industry as we go forward.
Right. And the challenge in execution is what? People, or what is the key constraint that you face in terms of trying to grow faster than that?
I would not say key constraint, but it's important to get the ecosystem right. So when I say ecosystem, I mean your risk management practices, your marketing, your local brand awareness, your focus on training people, grooming people. So once your ecosystem starts working well, then there is no obstacles, no looking back. Now and then, here and there, a lot of new players would come in. Banks will increase their play. So those are the short-term challenges that you face. But what we have seen over a period of time is that if you continue to be true to the customer and offer him the right set of products, you will continue to win in the market. And that's what has been the focus.
Sure. Thanks. So Bill, I'll come back to gold. Let's kind of move to housing for a minute. And you guys have, the housing is all in a subsidiary, right? Which is what you recently placed stake to Adia, right? So, or is it part? So how is housing kind of structured in the company?
Hi Sanjeev, thank you for asking the question. So HFC, which is the housing finance company, is a subsidiary of the IIFL Finance itself. It is 100% subsidiary, and very recently the news which you read about Adia. So they are extended their consent for acquiring 20% stake of the HFC business. So post that, IIFL Finance will have hold 80% and 20% will be with Adia. So that's how the structure is. And yeah.
So of course, if I look at the valuation, implied valuation of that looks pretty nice for that. But my issue is, unlike gold, which is, I think banks find it very difficult to do gold. But in housing, that's not the case, right? You have everybody there in housing. What do you add? Like, what do you bring on the table that is different? And what value do you add, you think?
So, yeah. So Sanjeev, if you will see that the total individual housing loan outstanding between banks and HFCs is about 20 lakh crore. That's all. Right. However, it sounds that everybody is into that business, but everybody has a lot of variation in the kind of business they do. In the sense that you can do housing loans looking at properties in lower parallel, where the average ticket size could be 20 crores. You could also fund somebody who wants 5 lakhs home loan. So everybody has their own target group in towards they want to lend. So interestingly, Sanjeev, you'll might be surprised to know that, for example, the average ticket size for SBI is 35 lakhs, right? Which is pretty high. HDFC is around 30 lakhs. ICICI Access again 35 lakhs plus. Even Bajaj Housing has an average ticket size of about 50 lakhs plus. So the aspiration for people to grow this business is in different segments.
Right.
So if you are having an average ticket size of say 35 lakhs, just taking a back of the hand calculation, SBI does about 12,000 crores a month, right? So for every crore, they will be doing 3 cases, right? So the total number of cases in a month they might end up doing is 36,000. So in volume, it might look 12,000 crores, but in units, it's just 36,000.
Right.
And India continues to have a huge shortage of housing. And the segment in which we operate, we have an average ticket size about 15 lakhs, 15 to 16 lakhs. So if you see all the large significant players, even LIC has an average ticket size about 27 to 28 lakhs, right? So the presence of people in the segment, which actually has the highest demand, is actually much lesser. And the players over there are either too small, or maybe the closest to us would be Canfin Homes, which has about 26,000 crores of AUM. We are about 24,500 crore AUM. So as far as demand is concerned or presence is concerned, I don't see there is any challenge there, at least from the demand side. However, obviously this product is a bit more non-standard, unlike a personal loan or a gold loan where the valuation of the asset is predefined. Here, every asset has to be evaluated both in terms of valuation and legal due diligence has to be done individually. That makes it a slightly more cumbersome and more complicated in the sense because every state has its own by their laws, their legal issues or understanding of it. So it's a pretty, I would say, a custom built kind of a product for every state and every kind of a transaction. So that has its own challenge also. That also provides a good moat for people who understand this and who don't understand this.
Right. Yeah. Sure. So, we were recently had a call with Andromeda, who kind of does, originates loans stuff. Now, everybody seems to be dealing with them right now, right? And so I was actually asking them this question: what remit is you get from different people? Because ultimately, you have, you're originating that loan and then giving it to people. What would you be telling someone like, let's say, an agent like that what kind of what profile are you looking for to say that it fits the thing,
So Andromeda is a distributor, right? And as I said, like the banks, their aspirations also run on volumes than on the units, right? We also work to a very small extent with them. But the thing is that every institution, every bank is going to actually give them a percentage related to the volumes they do. So largely their interest would lie in the big ticket, the bigger ticket, fewer transactions. Otherwise, there is an appetite to what one salesperson can handle. A transaction of 20 lakhs and 20 crores has some effort difference, but not so much. But you can multiply it much more. So what we have really experienced is for the segment in which we operate. So distributors don't contribute a lot here because obviously it is very difficult for them also to have such a high OPEX with number of people. And at the end of the day, they'll get paid on the volume they do with us. So for us, about more than 90% of the sourcing is in-house. So we have our own teams which do this sourcing for us. So for somebody like them, I can just say that if you are in the game of units, then we are the people to look for. Otherwise, I think their interest largely lies in the high ticket loans. which is better ROI for them.
Sure.
Yeah.
So then who is your typical client? Like, how would you define your client?
Yeah. So typically our client would be somebody demographically age group of 28 to 35 years, having the household income ranging from 35,000 to about 70,000, right? And we have almost 62 to 63% is salaried and about 35 to 38% is self-employed. In terms of salary, this guy would be into a blue collar job, or he could be employed in a private limited, or even I would say a class 3, sometimes class 4 also in a government setup. And from a self-employed side, he would be running a small setup where his monthly incomes could range from anything 40,000-50,000 to even a lakh of rupees. So this is a kind of a typical customer profile which we have.
Rajesh, a question for you on this. These two businesses are very different in ROA profile. That as a CFO, how would you allocate resources to these businesses?
You're on mute,
You
Rajesh.
mute. Rajesh, you're on mute.
Again on mute.
Sorry, if you see, you would, the ROAs between the housing and the gold would not be that different, simply because while gold has a higher margin, but the operating costs are also much higher.
Right.
In a housing business, the NIMs are slightly lesser, but then what you can get to cross-sell and the lower OPEX ratio and the lower credit cost make it as lucrative as the kind of gold loan business. So as of now, in terms of for every rupee that we put in gold loans and we put in home loans, we get more or less similar returns.
Right. Okay. Understood. And in terms of overall book right now, how much of it? So obviously gold loan and housing both are asset backed, but overall book, how much is asset backed?
So on the overall book, asset backed in the sense how much is securitized out?
No, I'm saying that.
No.
Okay, in terms of secured. Okay, so about if you would say about microfinance, about 10-11%, and a little bit 3% will do unsecured small ticket 2-3 lakh rupee loans. So about 14% would be unsecured and 86% is secured.
Right. Fair point. And just last question from me, and then Sanket, you can take it from there. In terms of growth, and I'm just looking at it. What kind of growth can you achieve without necessarily diluting yourself, let's say, too much from here? And what is the goal? What's the plan here? Like in terms of even dilution, how would you look at that? Like how would you?
So easily we are looking for the broad strategies in terms of growing the top line or AUM at about 20%. The bottom line will be anything between 20 to 25 because over a period of time, operating leverages will kind of kick in along with other positive factors. And if we are continuing to generate a 20+% return on equity every year, which we have done for the, like last year and partly for the year before that, the internal accruals should be enough to take care of the balance sheet growth that we want. And in that 20% growth in AUM will actually translate into a little smaller percentage of risk-weighted assets, maybe something like 16 to 18%, because we expect over a period of time the non-balance sheet requiring items to go higher and higher. Securitization and assignment will play a role in this, but also the co-lending guidelines. So if you see as of March, gold and home loan, both large products had close to 10% of the AUM already under co-lending, and this is just the start.
Right.
So the capital requirement will keep getting lesser and lesser, and the internal accruals will get faster. So in terms of we should be having good enough surplus capital over the next few years.
Right. And so any acquisitions that as a strategy that you're looking at, or you think
I think in the markets or the products that we are present, the organic opportunities itself are so large. Whether you talk about the urbanization trend or the housing shortages in home loans or in gold loans, the unorganized market and that is available to be tapped, microfinance is at a cusp. So actually, pretty much we have a hands full with the organic opportunities. But obviously, if an opportunity comes up, no, it's not like a no at all cost. But I would say we have our hands full with the organic opportunities.
Sure. Great. I guess we haven't touched upon the other businesses, but maybe a brief on that, and then Sanket, you can kind of take it from there.
So the other businesses are basically business loans and microfinance loans. Now, our business loans comprise about maybe 20% of our book, and close to 75 to 80% of that is actually secured, which is basically LAP, which is handled under HFC by Mono itself. So you see this loan, this part is a little out of the four, the business loans as a category overall. We have been going slow on this, but now it's time for probably growth to take shape again in this one. And microfinance is one sector that has really grown. It was a small microfinance company that we took over somewhere in 2017, and probably 100 200 crores, and now we have brought it to the size of close to 6,000 crores of AUM. We have put in sufficient capital in that business because that's going to be a large the kind of growth business for the next few years. We've had a rough, the whole industry has had a rough 2 years, but now I think even studies by NABARD, etc., suggesting that they are going to see something like 30% growth over the next 3 or 4 years. So we are very bullish on the microfinance sector. So,
what region, any region it is more dominant in, or?
So the company, before we acquired it, started in Karnataka, but it is kind of more or less well spread out. The major states that it has presence in are Rajasthan, Bihar, Karnataka, with no state individually more than 18% of the total AUM. Or ballpark in that range. So we really not, and that's a conscious decision because, as you know, microfinance is subject to, along with nature related problems, a lot of geography. If you're concentrated, it could really hurt you. So that's a conscious decision that we have taken.
Sure. Sorry. Thanks. Sanket, over to you.
Yeah, hi. So my questions are again to Saurabh sir on gold financing. So sir, in the past 3-4 quarters, a lot has been talked about as far as the competition in this space is concerned. Banks getting aggressive, or say fintech like Rupeek, and few others also coming. But lately they have tapered down in terms of their intensity. They have laid off the employees also. But coming back to say competition from bank, wherein people feel that maybe the market share from us will be taken away on the back of say offering lower rates. So my question is the unorganized space. Now that is the real piece, right? If you are seeing the shift from there to the organized space, then that is a larger market to still have. You said that industry would go 10-15% from here on, but within that industry, there's a lot to capture from the unorganized space also, and wherein our growth rate could be much higher than the 10-15%. So just say understanding on whether you are seeing the shift in the newer geographies that you have opened the branch. Is the shift from unorganized space to organized space now visible? And what are you what efforts are you taking per se in such geographies where you feel that there is a market to capture from the unorganized players in terms of say educating the borrowers about how better we are in terms of offering them a better rates and also safety of their ornaments?
Great, Sanket. So very, very pertinent question, Sanket. The shift from unorganized to organized is a gradual play, and it's a process, right? And it's a continuous process which has been happening for last few years. So let me answer this in two parts. As banks come into this space and as banks increase their play, while the competition will increase in the market, but at the same time, there is a lot of difference between service of the banks and service of the NBFCs as far as gold loan customer is concerned. So there will always be an advantage that NBFCs have in terms of servicing, in terms of touch points, and in terms of exclusivity. My branches are directly working on for gold loan customers, whereas banks have multiple products, multiple different assets to sell, and they have multiple opportunities in terms of fee income, etc. So banks focus is on multiple products, whereas my branches have red carpet for gold loan customers. So that's where that's a big difference. Also, how we service the customer during the journey also makes a big difference. And we've seen that the banks typically, private sector banks typically have a higher ticket size, maybe 1 lakh, 1.5 lakhs, thereabouts, whereas the NBFCs typically have a smaller ticket size, about 50 to 60,000 on average. So there are two different customer segments that we're dealing with. But yes, there will be some shift, and that depends upon how we service and deal with those customers. Coming to unorganized, which is the larger play. Now, this segment the movement from unorganized to organized, a play on a couple of things. Number one is your distribution, how closer you are to the customer. So our focus has been to go to unbanked areas, underpenetrated areas, and go closer to the customer. The second is that there are a lot of inherent inefficiencies in the market, which in the unorganized market. Number one being that they charge high rate of interest. Number two, there is no transparency. Number three, people do not get a receipt or are not aware about safety of the gold, etc. Now, this is where, as you rightly said, a lot of work, missionary work needs to be done on the ground in terms of creating awareness, in terms of reaching out to the customer, in terms of convincing them to come to the branch and experience the organized sector and so on. So we have over a period of time, we have looked at certain models which work. And when we open a branch, we reach out to these customers. There's fixed templates that we have for each of these geographies. And that helps in moving a lot of these customers from unorganized to organized segment. And I think this shift is gradual, and this will continue to build on as we go deeper and deeper and reach closer to the customer.
Sure, sir. About say expansion, there was a report from KPMG wherein they were saying or they were highlighting certain geographies where the tonnage with the households is larger, but they are not yet acquainted to this financing way, like lending against gold. And the key geography that came out of that was Northeast. So the states like Tripura, Assam, Sikkim, Manipur, and also some part of the north like J&K and Ladakh, wherein the existing old age players are still not present in any meaningful way, and we have been able to make some inroads there. So how do you see that geography? Is it really a gold mine in terms of say fetching incremental growth and a sustainable growth from here on?
So there are some underpenetrated markets where maybe a lot of NBFCs have not gone, and there is a lot of opportunity there. And we are going deeper into East, Northeast, and all those pockets as well. However, having said that, see, if you look at the overall country, it's too large. And the amount of opportunity on gold loan is available all across the country. The amount of gold holding that is available is humongous. And if you look at South, there is a huge opportunity because they're the largest gold holding in South overall in terms of all the 4 states. They have a large gold holding. So the opportunity is big, but it is cluttered. In other pockets, north, east, west, all across the geography, there are opportunities for us to go to underbanked, underpenetrated areas. If you look at the sheer branch network of SBI, which is about 22,000 plus, whereas if you compare to a gold loan NBFC, the largest lender in gold loan space has got 4,500 plus branches. So there is huge room actually to really reach out in all across the geographies. And wherever we have opened in underpenetrated markets, we've seen a lot of opportunity. It takes a little time, but then the opportunity is huge.
Sure. And so we happened a big bunch of branches in FY22. So while we are in FY23 or say taking a view of 1 year ahead, also FY24, do we have a plan for any meaningful expansion, or FY23 will be a year wherein you will see the new branches grow in its own, where the AUM per branch should also inch up, and maybe FY24-25 would be the year where you will think of opening the additional branches in clutter?
So we got license for opening about 700 odd branches, and we have opened most of the branches are there in various stages of opening now. And the whole focus is to grow and consolidate there. And as we move forward, we'll look at if we need to add more branches based on our internal assessment of geographies and internal assessment of markets. And we'll relook at the whole scenario. But as I said, there is a huge room for expansion, and based on our plans for the year ahead, we'll definitely relook at it.
Okay. So you think for us as a player, say maybe 20-25% CAGR, I'm talking about just the gold book. Is it sustainable for next 2-3 years?
15-20% CAGR is definitely sustainable. And if the markets remain stable, gold prices remain stable, I think there can be better opportunities.
Okay. Sure, sir. And had one question to Rajesh sir on this regard, and then I'll have some couple of questions on housing. Rajesh sir, you have worked in banking setup earlier, wherein those banks were also doing gold loans. Can you highlight what are the execution challenges that banks observe, and due to which it's been years, right, that the banks are also operating in the parallel universe, but they have never been able to scale up their gold book. So is it a pace which they focus just when they have lesser avenues for growth, and as the economy picks up or the capex cycle begins per se, the focus will again be to the other core products, wherein they incur less cost to income, and also as far as execution is concerned, there is a less manpower to deploy. So what's your view on that? How banks look at this business versus how we look at this business, since you have worked in that?
So, see, at a very macro level for banks, that is the big banks that I am talking about, the gold loan business, gold loan do not even compromise 1% of the total loan book. So it's one of those things that cannot have more than some bandwidth that they can give. Whereas in our case, even at a group level, it is 1/3 of the total loan. Likewise, when you come down to a micro level, at a branch level, the bank branches are typically multi-product branches and typically liability-led branches. Their entire largely focus is on garnering the liabilities for the bank. They do generate leads, etc., for assets, but that's also like a add-on business. The main business is the liability business. Whereas our gold loan branches are singular, 99% or definitely 95% plus businesses gold loans. Branch managers full evaluation and everything depends upon how he does on gold loans, whereas in case of bank branch manager, it's just a by the way product that you have. Also, the teams, you will have the branch banking team and you have a separate gold loan team reporting to some other head who actually has just come and got some space there to operate. So he never basically gets the full support that he should be getting to grow the business. And then obviously that reflects in the lower service levels that the customers get. And that's the whole reason why a certain set of customers come to NBFCs then. So it's basically the design architecture of the bank structures which gives them strength in many things. But as far as gold loans is concerned, it's basically a drawback for them.
Right. And I missed one question to Saurabh. So Saurabh sir, for the unorganized space, maybe the rates start at 28 and it goes on to 40%, 27, 28 to 40%, and maybe a year back, all these organized players were also at 23, 24%. So maybe 300 bits of difference was not that elastic for them. to leave their comfort with say a money lender or a pawnbroker with whom they have been dealing since years, and maybe the shift didn't happen then, but now that all the financials are below 20%, and I don't see maybe from a year or two from here also it would go meaningfully about 20. So do you see this now 700-800 bips of say difference which is now been created between the organized customers and the cream customers from say unorganized space who used to get a lower end of the rate? For them, the shift would become eminent with a little education also. So do you see that, and is that a correct understanding to look to?
You're right, Sanket. So the difference between organized and unorganized players have been giving loans, not, I would say, starting from 3% per month to 10% per month. It depends upon geographies, pockets that they operate, and the kind of ticket size that they operate in. But these loans range from 3 to 10%, whereas the NBFCs typically range from 12 to 24% in a best case scenario. So the differential is huge, and it's a question of how do you reach out to these customers, create more awareness, and make them comfortable with coming to the organized play. Sometimes we have seen in our interaction with customers who are dealing with the money lenders, the first and foremost thing is the familiarity, and that's why they go to money lenders. And the second thing that comes is that there's a lot of hitch in walking into a organized bank or NBFC branch, because they feel, oh, will they deal with me? Will they entertain me? What kind of questions will they ask? And so on and so forth. So there is a lot of hesitancy. When you deal with them, when you create that awareness, you get those customers into this fold. But the
Sure.
rate differential is huge for them to move. So it's a question of education, awareness, and continuous missionary effort on the market.
Sure, sir. And one question to Monu, sir, on housing. Per se, we deal in say 16, 17 lakh ticket sizes, and particularly outskirts of the urban cities. So, is there any thought process maybe going ahead that we would look to also enter or go down the ladder, maybe towards semi-rural or rural areas, wherein maybe the competitive intensity would be much lower, pricing power would be much higher? Is there any thought process in mind to maybe tap that geography?
Yes, Ankit. So you're right that for a good period of time, we have been focusing on the suburbs of the urban areas or tier one cities or metros. That's been our strategy. And I think there was a lot of merit in that, because of the fact that once the government announced housing for all way back in 2015, it really pushed a lot of developers also to get into this space, especially during the times of 2015, 16, 17, when the mid segment and the premium market wasn't doing too well. They announced some very attractive SOPs for the developers under 80IB to develop these properties. And also there was a good subsidy which was being given to the customers. So initially the affordable housing had a challenge that there wasn't enough supply coming from standard developers, in the sense that the supply was just not there. Everybody was trying to cater to a very different segment, and there was no formalized developers moving into this segment because of the margins are lower. It's a high volume game, it's a high rotation game, and it's not a high margin game like you would get from premium properties. So there was a tremendous increase in supply, and I think at that point in time our strategy was just right. And so we were also able to give subsidy to about 56,000 people worth 1,300 crores, and we have another 10,000 applications pending worth another 300 crores. So we might end up with something like 68, 70,000 successful beneficiaries with about 1,600 crores. So it was a right strategy at that point in time to do this. And as I mentioned earlier also to Sanjeev, to say that it seemed that the competition intensity obviously is there, but to say, because the focus area for most of the established housing players, the larger players, has not been to say that I want to fund PSL or I want to fund affordable. It's been to just do retail. And the definition of retail for a established private bank could even be a 10-20 crore housing loan as well. So interestingly, the volume, they're still into the volume game, and not very many people were in the unit scheme. However, in the last about year or so, we have gone to deeper geographies, and we have increased our branch count significantly. But we have chosen few states. We are at a district level. So like the focus states for us is like AP, Telangana, Karnataka, Tamil Nadu, Gujarat, MPCG, Maharashtra, where we are going deeper. Earlier we were present in the top 3, 4, 5 cities of the state. Now we are present fairly deep. So as of March ending 21, 22, we had over 200 branches, 202 branches then, and we expect to open another 80 to 100 more branches in this year. So that has been our thought process, and we would like to go more into these areas. Obviously, there's one more thing, Sanket, we have to keep it in mind, is that you can always chase the demand at different places, but it comes at a cost of high OPEX. And tomorrow the servicing or the collection cost can also be very high. So it has to be very well articulated that either you keep on increasing your width of places or you increase the depth where you are. So I think to be more efficient, because this is a low margin business, so you have to keep the OPEX in check, and demand is always there for this or any of the products in this country. So I think how efficiently you can control and manage OPEX and credit cost and post sales collection cost, I think that is paramount, rather than just chasing demand, because no much amount of extra interest rate you get can offset the significant high OPEX or high credit cost. And as you know, if you are tracking other regional housing finance companies, they run on very high OPEX, extremely high OPEX. They run on that because it's a very manpower intensive structure they have. We haven't discussed, but we have a fully 100% digital process. The entire onboarding and decisioning happens on an app or a tab. So it is a paperless, there's no file which is picked up. And the entire process under about 30-35 minutes, the sales guy will get up telling you whether you can get a loan or not, and this should be your eligibility. So that's a pretty first in the industry what we have done. Now it gives us a lot of confidence that now if you expand, you will unnecessarily not incur a lot of OPEX, because typically in any other housing finance company, there's a typical branch-led model. You have a branch manager, you have operations person, you have credit person, sales person, collection person. So here we can run at a 1/3 staff what usually the other institutions will do. So we know that we are expanding now, and we know the OPEX will not eat into this whole thing and not pressurize, and the unit economics will work favorably with a very low gestation period. Otherwise, you might end up doing loans, but the gestation period to justify the cost is too high.
Okay. And sir, last question to you would be that maybe we would have in mind about a separate listing at some point in time of the housing business. Is there any say size in the mind, or it's not on the cards as of now?
I think, Sanket, we don't like to see too far ahead, but I think for now with Idea coming in, it gives us a lot of confidence and also a lot of breather to grow. And I think we will see as things come. But for now, I think our job is to make use of this investment to the best of our abilities, and show to the market and otherwise in terms of scaling up and giving a continuous performance which the market can acknowledge and see, and rest later on we will see as the right time comes.
Sure, sir. Sir, coming back to Rajesh, sir, last two questions from my side. The one is, can you spend a couple of minutes in explaining your JV with Open, recent JV that you have announced, and how the same is going to benefit IIFL Finance as well as Open customers? And then second and the last one is closing outlook, maybe on AUM growth from here on, and the kind of return ratios that you expect going ahead for next 2-3 years. Yeah, that's all from me. Rajesh, sir?
Open is a new bank. it has about 2.1 million customers, and it has a tie-up with a large number of banks for liability products. So effectively, what a customer of Open does is the accounts that they open through Open with these banks, or the accounts that they already have, they can operate through the Open app, something like a GPay, let's say. But you can do many more transactions. So if a bank has maybe having their own net banking, but you can do the ease of experience or the customer experience interface, etc., is much smoother through the Open platform. And Open has integrated all this with their accounting software, proprietary accounting software. So basically, when you transact, the backend accounting is also automatically taken care of, and the kind of reports, and so it's kind of an integrated package that they offer to their customers. Now we have entered into a JV, which will be kind of 51-49, 51 IIFL and 49 is Open. What will the JV basically do? Now, being an NBFC, we obviously do not or cannot offer liability products. But through the JV and through the tie-ups that Open has with all these banks, our entire 8+ million customers will now be able to offer liability products and the same ease of use and experience, superior experience that Open's customers can get. So we can get as close to a complete package as possible with this tie-up. Similarly, Open already has 2+ million customers. It opens up the possibility of we selling our various loan products to their customers. So all in all, it opens up a completely new product suite, access to a whole range of probably the whole financial experience, and a 2.2 million customer base that we can tap into. So this is what the JV is, the joint venture will be all about. Coming to outlook, obviously, broadly, we are looking at a 20% or top line growth and anywhere between 20-22, maybe a little higher bottom line growth as efficiencies kick in at higher scale. Return on asset will be closer to 3%, give or take 0.12%, etc. And our endeavor will always be to have a return on equity ratio in excess of 20%. So, of course, there will be years in which there will be setbacks and so on, like the COVID years, etc. But the long-term trajectory is intact. Directionally, this is the direction that the company will go in. And all these numbers that I mentioned is basically whenever we go to work, these are the numbers that we keep talking about, that these are the things that we have to achieve.
Okay. Sure, sir. So those were all my questions. Sanjay sir, you have anything?
No, I think anyway we have run out, also, and I think I think this has been pretty comprehensive. I think we got quite a lot of idea, and I'm sure we'll keep the dialogue on. And it looks pretty exciting space, you guys, and and as all the businesses look pretty interesting. And as you said, if you actually manage to achieve that 20% growth with 20+% ROE and 3% ROA, I think, of course, it'll, and with compounding that India offers, I think this will be a really amazing story. So yeah, it was great to kind of hear views of you guys.
Thank you so much, Sanjeev, for kind words, and thank you, Sanket, for organizing this. It was wonderful reaching out to you, and through you, we hope to reach out to a large number of investors whom we can kind of tell our story, and so that as many people are aware of us.
Sure, absolutely.
Sure, sir.
So, thanks, Rajesh. Thanks, Saurabh.
Thank you.
Thanks, Monu,
Thank
and
you.
thanks, Anup, for this. Yeah, thank you.
Thank you.